My name is Sondre Myge. I head up ESG here in SKAGEN Funds, and I look forward to spending half an hour going through active value ESG, the bridge in the real and the financial economy. I'll try to be precise and hopefully leave room for some Q&As at the end. I'm going to start by just raising a general premise that I'm going to try to refute with this presentation, which is the general claim that value investing is incompatible with ESG, as so-called ESG stocks have growthy features and command a premium price. And so what I'm going to try to do is reject that misguided claim once and for all, and indeed highlight why we believe that active value strategies are ideally suited to ESG principles, as well as the ongoing and changing market winds, and act as a bridge between the real and the financial economy. I will highlight the three agenda points, these three agenda points to support this claim. I'll start by mapping out what an active value ESG proposition in SKAGEN funds look like in order to connect it to a dynamic that we believe is core to ESG, namely linking the real and the financial economy. From which I'll exemplify three of our current investments that in our view demonstrate sustainability, but which for strange reasons do not make their way into your typical ESG portfolio. So without further ado, let's unpack the active value ESG proposition. Professor Alex Edmonds cuts to the core when he says that considering long-term factors when valuing a company isn't ESG investing, it's investing. Personally, I couldn't agree more. In essence, there is nothing revolutionary about ESG as it pertains to how active value investors like SKAGEN have always looked for and valued investment opportunities. What has changed is a tremendous interest from clients for products that engage with these topics in a systematic way. This in turn has led to a plethora of different strategies, often with a thin empirical backing and investing rationale in terms of financial risk and return implications. As the graph to the left shows, the numbers are clear. Asset owners are increasingly removing capital from non-ESG active strategies and instead placing them in dedicated ESG strategies. Active strategies make up half of those flows, but with value strategies making up a relatively small part of that flow in turn. I suspect that many of you may have noted the recent criticism of ESG, and we support most of that criticism. In fact, we've raised some of those points ourselves. In our view, the explosion of demand has created a plethora of products, strategies, and dubious ESG scores and KPIs, such as promoting fund carbon footprints as a supposed evidence of ESG delivery, with additional confusion and contentious debates arising from analytical shortcuts and binary worldviews. In particular, I would say SKAGEN pushes against the view that of sort of framing industries as ESG versus non-ESG industries. Our real economy is not made up of silos, but of supply chains and supply and demand. Moreover, there is no automatic connection between good sustainability credentials and financial outperformance, as shown by the graph to the right. This gross simplification of real economy realities has rightfully put ESG at a crossroad in terms of what is actually being proposed. And you know, for a company like SKAGEN, the same principles really apply when looking to find the sweet spot between long-term financial returns and sustainability credentials. We talk about cheapness and change, looking for companies that have been overlooked by the broader industry, but has a clear trigger that will realize significant returns over a longer investment horizon. And these misunderstandings or overlooked companies are often so on the back of sustainability. As another adage goes, stocks are not cheap and popular at the same time. And whilst many of the ESG darlings have been expensive and popular, the market routinely misses the mark on real economy realities by writing off structurally important industries such as mining and industrials. Naturally, in SKAGEN, we go another route. Our equity strategies are all under Article 8 SFDR scope due to our systematic ESG framework, which analyzes material ESG factors for each investment case. Our key tenets on sustainability is that real economy exposure trumps ideal economy positioning. We try to read the world as it lays and pick the best ideas for the portfolio accordingly. We focus on long-term improvement rather than a binary and misunderstood understanding of what is sustainable today, In particular, we believe that strong ESG performance and improvement over time enables more resilient businesses that are more adaptable to a volatile and changing world. In essence, the framework can be summarized accordingly. Our funds, represented by the paper sheets, analyze the value proposition of companies, which include a view of double materiality, meaning how does a company interact with its surroundings and how is the interplay enabling or challenging the investment case over a long investment horizon. This combination brings us closer and deeper into the story of a company. What will drive its success, what will drive its risks, and whether it warrants the capital trusted to us by our clients. And this interplay is by no means easy to balance. And as it is a question that is a topic of discussion for many of our clients, I want to offer our view on how we deal with owning carbon-intense investments and how it balances up against moral expectations. It is a timely topic, and seeing as I'm presenting from the energy capital of Europe, it is a topic we've given a great deal of thought. How do we defend, based on values and the notion of what is right, owning fossil fuels and carbon emission exposure, whilst we exclude activities such as gambling and tobacco? Our very first response is that the moral utility function of not owning tobacco and gambling is very different to that of not owning fossil fuels. Fossil fuels is a byproduct of society's energy use, energy which drives our economic development and which, without or if scarce, would invoke mass societal chaos. Not owning tobacco and gambling is a choice with personal ramifications, but not owning energy is not really a choice as such. As epitomized by the famous Kaya identity, energy drives wealth and development, and there are increasingly strong economic incentives to deal with its most unwanted externality, namely CO2 emissions and its equivalents, such as methane. And while the transition is underway, our energy systems will depend on a variety of fossil fuels to power and maintain social stability in the interim and for the longer term. It is simply the reality versus the ideal of the transition. For the next section, I'm going to unpack this dynamic in more detail because it sits at the core of engaging in ESG as an active value and long-term investor, which is to bridge the real and the financial economy. Because I must admit, in sort of a moment of frustration, I felt the urge to get to the bottom of the misuse of ESG KPIs as it relates to climate risks in financial portfolios and the paradox that we as a society demand an energy transition, but not on our own books or nor necessarily in our daily lives. So we did some rudimentary analysis of the supposed linking between the financial and the real economy. We collected 5 annual observations capturing the boost and growth of ESG investing and one of its most popular KPIs, which is the fund-weighted carbon intensity, which looks at scope 1 and scope 2 summed up, divided by $1 million or any other currency in revenue. And for us, an unintended consequence of simplifying complex economic dynamics through this one fund level KPI is that you achieve a fundamental disconnect between what you expect, which is contribution to reducing emissions, or the notion that you have carbon lean revenue with what in fact happens, and why we in SKAGEN believe that we offer a more modest but better integrated bridge between ESG as a factor informing financial risks and returns. Short story, what we did was we looked at the red line. The red line is comprised of global CO2 emissions, and as you can see, they've remained flat over the 5 observations. Yet if we only focused on the dark blue and the light blue line and the indicators comprised of carbon intensities from MSCI ACWI and direct emissions from MSCI ACWI, you would be forgiven to believe that financial portfolios were decarbonizing and contributing to a broader real economy story. Now, clearly, this is not the case. Financial portfolios have decarbonized by 25 to 30, a dent in the development of global CO2 emissions. In other words, the most favored tools for the job aren't working as intended. That is one consideration, but there are also deeper financial considerations and risks that follows. The first consideration is that this dynamic simply outsources emissions from listed equity portfolios over to other actors, in part due to brown spinning demands from investors, making equity markets less relevant agents to engage in bringing carbon emissions down. And secondly, as a direct result, we optically believe that we reduce and manage CO2 exposure, but in fact probably drive up financial risk of the product by foregoing the very real physical and transitional risks that still persist in the real economy for the constituents of the index. In SKAGEN, we call this dynamic the CO2 placebo, the spread between what you think is happening versus what is in fact happening. To make matters worse, one would argue, indices like the MSCI ACWI is the go-to reference for carbon footprint comparisons, and so by underweighting companies with a high carbon footprint, it's easy to game an even better carbon footprint and increase the CO2 placebo even further. To mitigate these unintended consequences, SKAGEN flips the approach from top down to bottom up. It doesn't matter what our fund KPI is, what matters is the companies we select and their long-term trend. We seek to manage the systemic through the specific. And like any investor, we read the cues from the system level and analyze what that means in terms of generating winners and losers. We view our funds as enablers of risk-adjusted returns and real economy enablers that interpret and read the financial system to identify the companies we believe are best placed to excel within it. Sustainability as a secular trend is therefore a significant driver of idea generation, investment analysis, and investment execution. In reading and selecting the best cases, we view our role to be ambassadors of the companies we own. These are companies that have a clear view on how to manage and improve on financially material ESG factors, albeit through a small but positive contribution to the system level issues that we are all concerned with. We are nearing the end, and so I guess I owe it to you to collect all the loose ends by highlighting 3 of our current investments which demonstrate this integrated story, but which for reasons beyond our comprehension are rarely spotted in dedicated ESG or sustainability strategies. So let's start in true contrarian fashion with Cementir, which is in our deep value strategy SKAGEN focus. In our view, Cementir is an excellent example of real economy needs meeting ideal economy wants. Cement is a hard to abate but crucially important input to build and modernize economies. It is durable and relatively cheap, which is of essence in particular in emerging markets that seek other sustainability objectives such as modernizing and growing and developing their economies and the quality of life within them. And with the advent of increasingly stringent CO2 pricing in Europe, we see opportunity costs for local carbon capture and storage reaching realistic and efficient levels. So do Cementir. They are a current laggard on environmental performance, but with comprehensive plans by management to dramatically reduce the carbon intensity of their cement production, we view that stronger environmental performance over the long term to be a strong value driver for our unit holders, all while reducing their operational carbon intensities, which is in part why SKAGEN Focus see more than 70% upside for the investment case. Next up is Brazil and SKAGEN Contiki, where Suzano is a high conviction post. Suzano is probably the most likely case to emerge in typical ESG portfolios, but which is overlooked due to their emerging market status or for some fear over political risk. SKAGEN, in fact, visited Suzano during our Brazil tour in January to see for ourselves, and it became clear very quickly how ingrained and ambiguous sustainability is for their economic success. Suzano is vertically integrated, meaning they grow and operate their own eucalyptus plantations, which they grow in and around virgin forest in the biomes they operate in. They do this as the virgin forest provides protection for the plantations from wind, fires, and other diseases that can impact their key asset, which is used to produce a wide range of pulp and paper. The vertical model provides further ESG protection through a strong circularity model where they can rely on harvesting from their own plantations, which in turn sequesters a significant amount of carbon dioxide, aided by active forest management and the surrounding biomes where they operate. The last stop, no pun intended, is a Canadian railway company found in SKAGEN Global. Canadian Pacific Kansas City Southern is a railway company and part of a misunderstood and supposedly troubled industry when it comes to sustainability. Yet in our analysis, we view them to be ideally suited to grow and contribute to the secular sustainability trend. The core reason for this is the significant CO2 substitution effects to be had by converting freight from road to rail, much akin to coal to gas fuel switching in the power sector. In addition, we believe Canadian Pacific has an additional competitive advantage compared to other rail operators. Not long ago, the company was simply called Canadian Pacific, but following public approval to buy and consolidate its smallest competitor, Kansas City Southern, they now comprise a one-of-a-kind rail network, spanning coast to coast across Canada, cutting through the US and into the Mexican industrial heartland and ports in the Gulf and the Pacific. The network, in our view, is ideally suited to capitalize on the road to rail conversion and to move the green transition across North America, which should accelerate further thanks to the Inflation Reduction Act. Curiously, CP's industry-leading track record on health and safety in their operations was a key rationale for the public board approving the merger, demonstrating how instrumental ESG inputs can be over the long term for significant business and value creation. And so yet again, in our view, we see a clear case where you have strong ESG support for a long-term investment case, and how these incremental improvements year over year helps deliver shareholder value whilst making small but humble contributions to the broader systemic challenges we're all facing. And so, as we hopefully break for some interesting questions, allow me to repeat my main message today. I hope I've been able to demonstrate why there is no contradiction in terms when it comes to active value and ESG investment strategies. It is in fact pure economic and financial common sense. In raising some of the limitations that we believe is challenging the ESG discussion today and criticizing it, such as the CO2 placebo effect, I've tried to sketch out how active value strategies can overcome these issues at the expense of owning more carbon in order to be part of the journey and improvement over a long-term investment horizon. This honest but modest approach focuses on incremental change hand in hand with our financial analysis of our companies. In combination, we believe that many small streams make a large river, as we say in Norway, as it pertains to moving the system needle of sustainable development.